There is one single number that could save your business thousands of dollars or cost it a fortune in workers' compensation insurance. And that one number is EMR, or experience modification rate. And here's everything we're going to go over about EMR in today's video. First of all, we're going to go over what an EMR is. Second, we're going to go over why it matters for your workers' compensation premiums. And number three, we're going to figure out how to lower it as fast as possible. So getting right into it, what is EMR and why is it so important? A high EMR doesn't just affect your insurance costs, but it can also hamper your ability to win certain jobs or contracts, especially in competitive industries like construction or manufacturing, where clients screen for your safety ratings. Because if one of your workers gets hurt on one of their jobs, then they could be on the hook as well. So they want to make sure that your EMR rating is on the lower end. And an easy gauge to go by if you have a good EMR rating or a bad EMR rating is to know whether your EMR rating is below a 1.0, which equals fewer claims and more savings. And if it's above a 1.0, then that means more claims and higher costs. And again, of course, affecting your ability to get certain jobs or contracts. So how is EMR calculated in the first place? Well, here's the simple version of the formula. It's claims history plus severity divided by payroll size. That gives you the EMR. Going into a specific example of how it's calculated, let's take a hypothetical HVAC company. And let's have these key assumptions. Number one is the payroll is $1 million for the year. The manual rate for the class code of HVAC technician is 5537, and the industry average nationally is about $3.14 per $1,000 of payroll. The actual claims in the last 3 years were 25,000. Again, this is a hypothetical example. And the industry expected loss is 20,000. So it's slightly above the industry expected. Just from an inference, we could already tell that the EMR is going to be above a 1.0, but let's see how much above a 1.0 it's going to be. So step one, what we're going to do is calculate the manual premium. So the way that we do that is calculate the payroll divided by 1,000 times the manual rate. So in our example, our payroll is $1 million, so we're going to divide that by 1,000, multiply that by the manual rate, which is 3.14, which gives us 3,140. In step two, we're going to calculate the actual EMR, and the calculation for that is actual claims divided by expected losses. So the manual premium in our example would be 25,000 divided by 20,000, which is 1.25. And in step three, we're going to calculate the adjusted premium. So in this case, the adjusted premium would be manual premium times EMR, and the adjusted premium in our case would be 3,140 times 1.25, and our premium would be 3,925. So a little bit above the industry standard for our premium. And a really good key takeaway here is that if the EMR is 1.25, that means that the claim history is 25% worse than the industry average, which is going to make your premium 25% higher than the industry average, which is what we can see in this case right here. And by the way, if you guys are struggling with a high EMR and you need a good broker to help you lower your workers' compensation premiums and of course your EMR, then why don't you contact us at quotes.commercialinsurance.io/total risk protocol, and we can see if we could help you out. Moving on, there are a few reasons why the EMR matters to your business. And it's not just from your premiums being lower if it's under a 1.0. What happens is if you have certain potential clients or vendors that are looking at your EMR and they see that you're above a 1.0 and you have a very lax safety culture, that's going to put them off from doing business with you, which would mean that you're going to get less business in general and you're not going to be able to break into larger contracts. So essentially, it makes it so that your insurance costs are higher and that your revenues are lower. So in a lot of situations, this one number can make or break your business. You could even think of it like a credit score for your workers' compensation premiums. In the simplest terms, EMR impacts not just your premiums, but also your reputation. So here are some tips to lower your EMR. Number one is to have a strong safety program. Number two is quick claims investigation. 3 is regular workplace inspections. And 4 is employee safety incentives. Let's dive into each of these in a little bit more detail. A strong safety program indicates a formal safety education program. This could either be a written training manual or a video training manual. I personally recommend having a video training manual that you have your team look over regularly as the best version of this. And you know for a fact that you have a good insurance broker if they give you this strong safety program when you sign up for your insurance. In fact, we actually provide our clients a formal safety training program before we even go out and look for a carrier for them. Because just proving to the carriers that we have a link to this training program before even signing up with them shows them that we actually have a culture of safety and that we deserve lower premiums. You also want to make sure that you file your claims quickly. You don't want to delay them because it shows the carriers that you're proactive about mitigating losses in the future. And having regular workplace inspections is very important to show that you have a workplace culture of safety again. And some things you could do is identify potential hazards, like making sure that you don't have any faulty or defective equipment, and making sure that all employees are utilizing safe work practices. And the last thing that you can do is reward your employees for following your safety program and protocol. And these rewards don't even have to be that big. They could either be simple Amazon or Starbucks gift cards, dinner for your employees' families, any kind of positive reinforcement will do. And a really nice bonus tip is to track near misses and not just accidents that you file claims for. So if you're very close to filing a claim for something, you want to make sure that you track that and see what caused the issue in the first place and mitigate it so that way you don't have to file a claim for that issue in the future. Next thing that you want to do is monitor your EMR regularly. You want to check it annually or more frequently if possible. Ask your broker to help you with this because regular monitoring helps you catch issues early on and avoid surprises. And I promise you guys that if you implement just one of these items over here, your EMR is going to start going down over time. So let's go over a recap of everything we went over in this video. What is an EMR? An EMR, or experience modification rate, measures your safety performance versus your industry. It also impacts your workers' compensation premiums and your reputation, either good or bad, whether it's above a 1.0 or whether it's below a 1.0. The next thing that you want to know is that you could lower your EMR by implementing safety programs and claim management. Again, your broker can help you with this. And the last thing is that you want to monitor the EMR regularly to make sure that you're not overpaying in premiums and that you're not going to lose business going forward. Again, if you guys are ready to lower your EMR and you need help from a competent broker that can help you do so, then you should contact us at quotes.commercialinsurance.io/total risk protocol. Thank you for watching.